One of the most common questions I get from borrowers and real estate agents is, where are mortgage rates going? Are they going up? Are they going down? Should I lock my rate today or should I wait? Now, the truth is, no one can perfectly predict mortgage rates, but there are very specific indicators professionals watch every day that tell us the likely direction of the mortgage rates before they move. Today, I'm going to show you exactly what those indicators are. We'll cover the 10-year Treasury yield, mortgage-backed security spreads, inflation data like CPI and PCE, employment reports, and how the Federal Reserve influences mortgage markets. By the end of this video, you'll understand how mortgage professionals anticipate rate movements before they happen. Let's get into it. The first and most important indicator mortgage professionals watch is the 10-year Treasury yield. This is the interest rate the U.S. government pays investors to borrow money for 10 years. Mortgage rates tend to follow the 10-year Treasury very closely. Why, you ask? Because the average life of a 30-year mortgage is actually around 7 to 10 years. Most homeowners refinance, sell, or move long before the full 30-year term. So investors compare mortgage bonds to 10-year Treasury bonds when deciding what yield they require. Historically, mortgage rates are typically about 1.5 to 2.5% higher than the 10-year Treasury yield. For example, if the 10-year Treasury is at 4%, mortgage rates might be around 6 to 6.5%. If the 10-year Treasury drops to 3.5%, mortgage rates usually fall as well. That's why mortgage professionals constantly monitor the 10-year Treasury chart throughout the day. While the Treasury market tells us the direction, mortgage rates are actually set by mortgage-backed securities. These are bonds created from pools of mortgages and sold to investors. The most commonly tracked bonds are Fannie Mae MBS, Freddie Mac MBS, and Ginnie Mae MBS. Mortgage lenders watch the price of these securities all day long. When MBS prices rise, mortgage rates typically improve. When MBS prices fall, mortgage rates increase. This is why you sometimes see mortgage rates change in the middle of the day. If mortgage bonds prices move significantly, lenders will issue a rate sheet reprice. Another key indicator professionals watch is something called the mortgage spread. This is the difference between mortgage rates and the 10-year Treasury yield. For example, if the 10-year Treasury yield is 4% and mortgage rates are 6.5%, the spread is 2.5%. Historically, mortgage spreads average about 1.7 to 2%. But during times of market stress, spreads can widen. For example, during the inflation spike in 2022 and 2023, mortgage spreads widened significantly. That caused mortgage rates to be much higher than normal relative to treasuries. If spreads begin shrinking again, mortgage rates may improve even if treasury yields remain stable. Inflation is one of the biggest drivers of mortgage rates. Investors hate inflation. Why? Because inflation erodes the future value of money. If investors believe inflation will remain high, they demand higher yields, which pushes mortgage rates higher. The two most important inflation reports are CPI, that is, Consumer Price Index, and PCE, Personal Consumption Expenditures. If inflation comes in higher than expected, mortgage rates usually rise immediately. If inflation comes in lower than expected, mortgage rates may improve. This is why mortgage markets can move dramatically when these reports are released. Another report that can move mortgage rates quickly is the monthly jobs report. This report shows how many jobs were created in the economy. If the economy is too strong, it can push inflation higher. That means the Federal Reserve may keep interest rates elevated, which can cause mortgage rates to rise. If job growth slows, it can signal the economy is cooling. That may help mortgage rates fall. This is why the job reports is one of the most closely watched economic releases in financial markets. Now let's talk about the Federal Reserve. Many people believe the Fed directly sets mortgage rates. That's not exactly true. The Fed controls something called the federal funds rate, which affects short term borrowing between banks. But the Fed can indirectly influence mortgage rates through monetary policy and mortgage bond purchases. For example, during the pandemic, the Federal Reserve bought trillions of dollars of mortgage backed securities. This increased demand for mortgage bonds and pushed mortgage rates to historical lows. When the Fed stops buying those bonds, private investors require higher returns, which can push mortgage rates higher. Mortgage rates also are influenced by global economic events. For example, wars, banking crisis, stock market crashes. During times of uncertainty, investors often move money into safe assets like U.S. Treasury bonds. This is called a flight to safety. When investors buy treasuries aggressively, yields fall. And when treasury yields fall, mortgage rates often follow. This is typically how mortgage professionals monitor rates each day. First thing in the morning, check the 10-year treasury yield. Then watch mortgage backed securities pricing. Then review any economic reports scheduled for the day. Major reports are usually released at 8:30 a.m., which is why mortgage rates often move in the morning. Throughout the day, lenders monitor MBS pricing for potential rate sheet reprices. Borrowers often ask, when should I lock my rate? There is no perfect answer, but here are general guidelines. If economic data is expected to be strong or inflationary, mortgage rates may rise. Locking earlier may reduce risk. If inflation data is cooling and bond markets are improving, rates may trend downward. But remember, mortgage markets can change quickly. So locking a rate is often about managing risk rather than predicting the future. So while no one can predict mortgage rates with 100% certainty, there are clear indicators professionals watch every day. The biggest ones include the 10-year Treasury yield, mortgage-backed securities pricing, inflation reports like CPI and PCE, employment data, and Federal Reserve policy. Understanding these indicators can give you a much better idea of where mortgage rates are likely headed. If you want to learn more about how mortgage rates really work behind the scenes, make sure to subscribe. On this channel, I break down mortgage underwriting, interest rate pricing, loan approval systems, and real estate financing strategies, so you can understand the mortgage system like an industry professional. And as always, I hope this helps.